For the first time in 15 months now, the Federal Reserve is holding steady rates. It's a temporary reprieve from the central bank's aggressive fight against high inflation. The decision comes after new data showed that inflation that defined last year has cooled off significantly. Here's Owen Fairclough.
A breather for the U.S. central bank after some of the most aggressive rate hikes in years. The Federal Reserve opting not to increase its benchmark interest rate any higher than up to 5.25% after 10 successive rate hikes when inflation began to spiral. But after topping 9% in June last year, those price rises have dropped. Eggs, one of the most visible symbols. The average price of a dozen now just over $2.50. That's almost half their January peak. And it's arguably a welcome breather for Fed Chair Jerome Powell, who had to firefight a potential banking crisis when 4 regional lenders collapsed in the spring, as well as prepare for the consequences of the U.S. defaulting on its debt, though this was averted. But Powell is cautious about pausing rates for too long.
Nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy.
Inflation has dipped and then risen again several times over the past year and was 4% at its latest count. Owen Fairclough, CGTN, Washington.
We also had new data on U.S. inflation that shows it's still cooling down. Wholesale prices dropped 0.3% from April to May, a sign that the rate hikes from the Fed are working. U.S. PPI made its smallest gain since December of 2020. Producer prices continue to drop month to month. Wholesale inflation has dipped thanks to a nearly 14% drop in gas prices and apparently eggs. These figures were all the talk among investors today. Of course, John Terrett has more on the cautious optimism on Wall Street.
What a day on Wall Street it was on the Wednesday session. Early in the morning, about 8:30 local time, out comes the PPI figure. Now, PPI is producer or wholesale or business inflation. It's not as important as CPI, which is consumer inflation, but it is still very, very important. And of course, it came in far better than expected. And the markets were thinking, well, this means that the Federal Reserve will almost certainly pause when it meets to make that decision a few hours later. And of course, in the end, that is exactly what happened, because as we've been reporting, the Federal Reserve, the central bank, did pause its 14-month interest hiking campaign. So things stand as they were for at least another month. We'll see what happens in July. They may decide to hike then, or they may do it later in the year, if needs be. The thing is, the chairman of the central bank, Jerome Powell, was much more hawkish in his words than he appeared to be in his actions, hinting at potentially 2 more 25 basis point hikes here in the U.S. economy to calm that inflation still further before the end of the year. Well, the Dow fell 428 points on those remarks, but recovered to be down 232, a decline of 0.7%. The Nasdaq was up 0.4%. The S&P 500 was ahead, but only by about 3 points. Bitcoin down 0.6%, 25,700. Coming up on Thursday, the next piece of economic data, which I bet the Fed wished it could see. In fact, I'm sure somebody probably gave them a hint or two. Retail sales, equally important, really. And we get earnings from the software company Adobe. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For more on what this means for the U.S. economy, or for that matter, the global economy, Thomas Hayes, founder, chairman, and managing member of Great Hill Capital. Good to see you. I love having you on the show, especially on days like this, because first of all, they should really kill these press conferences, because had he just made the decision and then stopped talking, I think the markets would have been fine. But then he started talking, giving this idea or hinting that there could be 2 more rate hikes. And I don't understand the purpose of that, other than to ruin the celebration, if you want to call it that, for lack of a better word. Why say that?
Well, this was a hawkish skip, and thanks for having me, Phil. I love coming on with you. The idea here is they need to continue to anchor long-term inflation expectations. So we believe the Fed is done. And why do we believe the Fed is done? Because the base effects from last year are at their most pronounced for the June data, which will be reported in July before the meeting on the 25th and 26th. And specifically, the key component in that is owner's equivalent rent. And I'm sure you've looked at the Redfin numbers and the Zillow numbers. They're really declining. And that's about 1/3 of the weight in CPI. Those numbers are going to give them more than enough cover to skip again in July, which is going to lead to a pause where they'll keep rates elevated through the end of the year.
When they say data dependent, are you referring the data they're looking at is this owner's equivalent rent, or is the data used cars and the price of eggs? Which one is it? Because all the numbers that we've seen has seen a significant pullback, albeit though the caveat is I'm hearing used car prices are inching forward again and some other things, but it sounds like to me that that's not the data they're looking at.
Well, the key is the weights, and they assign close to 40% weight on owner's equivalent rent. So that's going to be a key component. And if we look at the base effects, that's going to be very positive. We're going to see a 3 handle on headline inflation next month, and it could be even at low 3s. And that's really going to change sentiment around inflation expectations, and really give the Fed cover to pause yet again. And this is very constructive. So the dot plot is what spooked everyone, where I think what you're seeing is Powell has now moved more dovish than his colleagues. This was a concession where he would say, let's skip, let's see more data come in. He's worried about the banking instability that we saw a few months ago. He doesn't want to break more things. I think they put 2 banks under that didn't need to go under, of the 4 that did go under. And the dot plot is basically saying there's more there if we need it, but more likely than not, we're not going to need it. As a matter of fact, Nick Timiraos of the Wall Street Journal called him on that in the press conference. He said, if you're all so hawkish, why didn't you just hike and pull the Band-Aid off today? And he kind of fumbled and said, well, projections can always change.
But isn't it also a credibility issue? They've been saying, we're fighting inflation, we're fighting inflation, we're fighting inflation. Okay, so inflation has come down. I think the last number I saw was sort of around 4%, depending on which number you look at. And I get it, but I still stand by the fact that 2% is not a realistic number if you want your economy to be growing at the pace it's growing at. The only way that 2% makes sense if you don't want your economy to grow at all. So he's stuck. He's put himself into this position where he has to have the credibility to say that we're going to keep fighting inflation, or at least insinuate that you are.
Yeah, and to your point exactly, Phil, 2% inflation would be a complete disaster when you have debt to GDP at 120%. The only way to bring that down is the way we did it post-World War II, which is to run inflation hot and run nominal growth hot for the next 3 to 5 years. And we did it from 48 to 53, brought debt to GDP from 120 down to 63. We'll do the same thing this time. We need growth. We need above trend inflation. 3.5 is a good level.
So look, we've got markets hitting near new highs in Europe. We've got near new highs in Japan and parts of Asia. We have the S&P inching forward to breaking out. We've got a number of NASDAQ stocks very close, if not at all-time highs. The markets somehow kind of guessed this was all going to happen months ago, and we've been on a stealth rally for the past few months. Where do we go from here?
We're at a sea change. With the Fed out of the way, what you're going to start to see is a resumption of the downtrend in the dollar, which began in October and was interrupted in the last month in anticipation of the debt negotiations. You had a bid for safety in the dollar. You had a counter trend rally. Now that resumption is going to go downward, and that favors a new group of stocks. So we've been led by tech, the Magnificent Seven, that's driven 90% of the rally. Now we're going to see the other 93% of the S&P start to participate. Those 93% of stocks have actually performed 0% year to date. It's those 7 or 8 stocks that have driven all of the gains, and now we're going to get to the 93%. So first off, multinationals that get more than 50% of their revenues abroad, they're going to benefit from a weaker dollar. Emerging markets in China are going to start to get bid materially. Biotech, the risk on trade, as rates now stabilize and we can quantify, you're going to see money move back into risk.
Excellent.
And then finally, interest rate sensitive REITs will start to get bid, and small caps will benefit from bank stability.
I like it. So you're saying there's hope that the rest of us might see our portfolios finally bounce, because we've got FOMO on the ones that we already missed. Next time we're going to get some more stock picks from you. Thomas Hayes, good to see you again. Thank you.
Thank you, Phil.